So in lesson 14.1, we learned about estimating the amount of uncollectible accounts that you think you might have in the fiscal period. And in this lesson, we're going to look at how we write off an account that is uncollectible, and then also how you would put it back in if they actually pay. So canceling the balance of a customer's account that you're not able to collect is called writing off an account. So every time, like we talked about in the last section, every time that you allow a customer to pay at a later date with an accounts receivable account, you take the chance that they're not going to pay. If they don't pay, then you have to write the account off. And when you do that, you have to do a journal entry because you have to show that in your accounts receivable that that's no longer going to be something that will be collected. So you have to do a journal entry to cancel that accounts receivable. You should never tell the customer that you've written off their account, because if they're just going to say, well, then I don't have to pay it back. But if they still see it as a debt, they may eventually make an effort to pay it. So the transaction that we will do when you write off an account, the transaction has to reduce the accounts receivable account. So it says wrote off Edmonds Hospital past due account as uncollectible for $639.88. So the T accounts that go with that, first and foremost, we have to reduce the amount of the uncollectible account, which is a contra account to accounts receivable. So this transaction will reduce accounts receivable in the general ledger. It will also reduce the allowance for uncollectible accounts. It will also then reduce the balance of Edmonds Hospital in the accounts receivable ledger to show that they don't owe us anything because we're writing their account off. So those three things will be affected with the transaction that we are going to do. So when we do that, you're going to start with your date, of course. Then the account that is debited is allowance for uncollectible accounts. It's a memo. And then the credit is going to be accounts receivable / Edmonds Hospital. And we put that line there in the post ref to show that we're going to post this amount to the general ledger of accounts receivable and also to the accounts receivable ledger, Edmonds Hospital, to show that account has been written off. When you post this, you're going to post the date first. And of course, you're going to go to the accounts receivable ledger under Edmonds Hospital, and you're going to write written off in there. You're going to use the journal date, and this is showing each of the accounts. So you have your date in each account, then you have your page number. The only one that you write anything on is the accounts receivable ledger. That's where you write written off. In the general ledger, you don't write anything on the line. So you have your journal page number 16. Then you do your amounts. In accounts receivable, it's a credit. Accounts receivable is an asset. Assets have a debit balance. So you have a debit balance and a credit transaction you have to subtract to show that you have less in that accounts receivable account. You're going to do the debit and allowance for uncollectible accounts. Credit balance, debit transaction, again, you will subtract to show that new balance in that estimated account. And then you also post that credit in the accounts receivable ledger, and that gives them a zero balance to show that it's been written off. So sometimes after you've written an account off, because you haven't told them that it's written off, like I said a minute ago, you will get payment on that account. So sometimes after that account's been written off, they pay. When that happens, you have to do the transaction to show those effects. So on this one, we wrote off that account back here in whatever month that was, January. And then in March, you get payment from them. So we received cash in full payment of Edmonds Hospital's account previously written off as uncollectible. So we have to reopen that accounts receivable account. So you're going to go back and basically reverse that entry. You're going to go back and debit accounts receivable to increase it, to put it back into the accounts receivable account. You're also going to put it back into the allowance for uncollectible accounts. And you're also going to go back into the accounts receivable ledger and open up Edmunds Hospital's ledger again. You're basically just reversing what you did when you wrote it off. So, debit accounts receivable / Edmunds Hospital, credit allowance for uncollectible accounts. They don't call it a reversing entry, but it basically is when they pay. So your date, your debit, your credits, and the amounts. Then you have to do the transaction for recording the payment. So the first transaction that we just went over is basically reopening those accounts receivables accounts. Now we're going to do the transaction of receiving the money. So we have to record the debit to cash and the credit to accounts receivable. So in this transaction, which you have to do first, you've opened that back up to show you have a balance and have that amount in accounts receivable. Now you're reducing it because we've received the money for it. You're also, in this first transaction, you opened up back Edmunds Hospital account. Now you're showing that they've paid it. So you're going to go to the cash receipts journal, because that's where we put every time we receive cash. You're going to put the date, write Edmunds Hospital on the line, the receipt number. You're going to put the amount in the accounts receivable credit column and in the cash debit column. So after you have done those transactions and you post them, you're going to first post to the general journal to the general ledger account. Then you're going to post the debit portion of the general journal entry to the customer account, which is down here. Then you're going to write the words reopen the account, because right up here in this first transaction that we talked about, we wrote written off because we were writing that account off. Now they've made payment, so we're reopening that account to show they have a balance. Then you're going to post the cash receipts journal to the customer account and to accounts receivable and allowance for uncollectible accounts. What that does is it basically puts, the first one puts everything back, the reopening puts everything back in. Then when you make the payment, it shows them paid off. So the difference here we had a zero balance because we wrote that account off. It was uncollectible. Then we reopened it and then they paid it. So it's really important that you write these things on the lines of the accounts receivable account, the written off and the reopening. And that's how you write off an account and how you reopen it when you've received the money.